right now, I think these numbers don't really sway it too much. So we're probably looking at that next rise in September as they try to get the OCR back to a so-called neutral level.
Kia ora, and welcome to New Zealand Property Market Podcast, brought to you by Cotality for the 27th of July 2026. I'm Head of Research, Nick Goodall, and today I'm joined as per usual by our Chief Economist, Kelvin Davidson. Kelvin, hope you're keeping warm this morning. It's a bit of a chilly one throughout the country, but let's get straight into things today with the release of our monthly chart pack from last week. Sales volumes, probably the one key thing to talk about. Some of the data within there, I suppose it really just reflects, the weakness of the market at the moment, particularly when we're comparing year on year. Do you want to take us through the detail from the chart pack as it pertains to sales volumes?
Yeah, for sure. Yeah, so I can tell you there's a bit of a chill in the air in Canterbury this morning. That's for sure, and a bit of a chill in the property market too, maybe. But yeah, so sales volumes, we've had 6 falls in a row now. When you look. Now, this is across private sales and real estate agents, so adding in those private deals. Yeah, 6 falls in a row year on year. So, it's go back to the start of the year, we're anticipating some growth in sales. Now, actually, it's been sort of going the other way, if anything. Now, these aren't big falls, it's not collapsing, and the level of sales is still relatively normal, I suppose you'd say. But yeah, compared to that sort of market outlook we had of possible growth, I guess it's just showing there's still caution out there, buyers and sellers, in a reasonably cautious mood. No one's sort of in any rush. Certainly buyers aren't needing to rush with a lot of listings on the market. But then we're not really seeing forced selling either. I mean, yep, there's some sellers who are having to drop their prices a little bit, but there's no real mass unemployment or anything like that. There's a story on Radio New Zealand this morning just around mortgagee sales, how low they still are, and people are finding a way to keep servicing that debt. So yeah, I suppose, from both sides of the equation, no one is really having to rush at the moment. And I guess it's just resulting in, a reasonably soft level of activity. So yeah, I mean, to get really precise, we've had 43,183 transactions so far this year across that first 6-month period, down by 4.2% from the same period last year, which was 45,081 sales. So yeah, it's down a bit. I mean, 4%, yep, compared to where we were thinking we'd be, which was up, maybe 5 or 10%. It's quite a big gap compared to that. But yeah, it's not things aren't collapsing. And as I say, the number of sales is around about normal. Maybe it's a touch below average, but not too bad. Certainly higher than where it was back in 22 and 23 when we're at sort of 40-year lows for sales activity. So yeah, I think it's ticking along. Yes, we've had 6 falls in a row, but it's not collapsing. And I guess just highlighting that caution that's out there from both sides of the equation. So yeah, other things in the chart pack. I mean, no real change in terms of values or what we're seeing for listings or those buyer groups we've covered off on the past couple of weeks on the podcast with first home buyers really strong. Mortgaged investors just getting a little bit more cautious, perhaps. So those things are sort of ticking along, and yeah, sales pretty low, or at least the growth has turned negative in the past few months too. So yeah, it's taking over.
Yeah, exactly. Yeah, I think that, that context is important, right? Like, it's not just necessarily the comparison year on year. It's the comparison where we expect it to be, because we did expect that growth to come through. Now, there's no surprises to why this is. We know the uncertainty, we know with the global economic shock that's going on right now, the fact that's showing a weaker economy here as well, higher inflation, all these things are playing out to less turnover in the property market. And I think one thing I try and point out sometimes with this is that everyone goes, well, what does it really matter? Well, poor real estate agents aren't doing as many deals, so their wages are coming down, their commissions aren't there as much, but it's like there's so many other things that are connected to the property market as well. Some other businesses that when there's more turnover, they're getting more jobs, more business, and so that does lead to, more growth in the economy as well. So, when we're talking about sales volumes, not values, values I'm happy to see constrained and restrained for a long period of time, whatever needs to happen. But when it comes to volumes, there is, definite economic activity that stems off the back of a transaction happening in the residential property market. So that's why I suppose we pay close attention to it. It is a good indicator of the broader economic situation. And so the fact that it is weaker than last year when we we're expecting it to be higher, that does tell you quite a bit about what's going on. I did just pull out some of the regional data as well, mostly just for the main centres, because there is some difference there. I mean, Dunedin was the only main centre that saw some growth over the last 3 months compared to the same 3 months the year before, up 7.4% actually. Though interestingly, when you look at the monthly data, June did dip itself by 4% year on year. And partly I suppose this is a good indication, and same with Tauranga actually, as to why we often report this as a 3 monthly change year on year, because the monthly sales volumes can jump up and down. It can depend sometimes on how many working days there are in that month, how many Fridays there might be, which is, maybe when more deals get done as well. So, we do sort of extend out the data we're tracking to get a better feel and not be too, I suppose, jump at a trend that's not real. Tauranga, again, is another example of that. It's basically been weak for a year. I think, basically, 11 of the 12 months, last 12 months has been down year on year. But in June, sales volumes were up 38% compared to the last year. But yeah, again, June, when you look at it on a longer term chart, you can see that June sales volumes in Tauranga last year were very weak for one reason or another. So yeah, that 3 month rolling measure that we track on a consistent basis is really important for that reason. Outside of that, Christchurch even was down 1.1%. I know we'll probably touch on expectations for the home value index later on, where we might start to see even Christchurch starting to slow down as well. But yeah, sales volumes in Christchurch down 1.1%. Auckland, though, the weakest of the main centres, down 7.8% over the last 3 months. So again, just continued weakness in that largest market as well. Again, lots of listings up there. That demand has slowed down. Relatively expensive prices, I suppose, in general, even though we have talked about, lots of creation of townhouses, and they're in a relatively affordable position, and the overall affordability metrics are okay in Auckland. I suspect that, that middle part of the market we've talked about, where those movers are typically active, that'll be something holding back that Auckland market in terms of turnover as well. So, yeah, you sort of got to weigh all those things in there. That's what the chart pack does, tries to pull all those massively different data sets together, talk about the broader market one of your first pages just has an eight bullet point summary of what's going on. So, yeah, worthwhile looking at some regional detail there. Certainly go into the economic factors, those deeper market factors, and, split the market and by the upper tier and middle and all that sort of stuff too. So well worth going and checking that one out. But yeah, I think that's a decent overview of that. Anything else on sales volumes on the chart pack that stirred in your mind then?
Not too much. I guess just reiterating that it's not just real estate agents that are sort of generating business from transactions. Yeah, you got property valuers. Think about you're selling your house, you get a tradie in to touch it up, paint it up, fix the cupboard, whatever. So there's that sort of activity, and I guess retailing as well. People when they move into a new home tend to get some new furniture. The old stuff might not fit, or it might look a bit ratty. So there is a lot of associated services that go along with house transactions, as well as construction, to be fair. I mean, new builds are, there's this whole talk of, housing being unproductive, and maybe there's something in it, but there's also those other associated services, and obviously, generating new builds generates a lot of work for tradies and that sort of thing. So yeah, it's nothing's ever straightforward, I guess.
No, exactly. Yeah, not one stats rule them all, that's for sure. All good, mate. Well, actually, the other big release last week was the CPI inflation data for Q2. Headline figure, of course, up to 4.1%. Slightly above expectation, especially if we say the expectation of the Reserve Bank. I know that their original forecast back in May said it would likely be 4.3%. When they had the monetary policy review a few weeks ago, they adjusted that to 3.9%, and it ended up in between those two things. 4.1% was probably around about consensus of all the other economists that published their forecast as well. So it wasn't too bad compared to expectation, even if it's slightly above the Reserve Banks, which is, I suppose, what matters. I don't know, Kelvin, do you want to get into some of the detail here? Obviously, there's a bunch of measures that talk about core inflation, stripping out petrol and diesel prices and energy and all these other items. Can you give us your take on where this actually lands and what it means for the future, how bad the spike might be, and ultimately what the implication is for the OCR, which I know usually this is the case, but even more so at the moment, we do tend to go, what does everything mean for what the official cash rate's going to do at the next decision, which in this case is early September from the Reserve Bank. Yeah, your interpretation of the CPI data, roundup of some of the other bank economists, their takes on it too. Where are you at with it?
Yeah, I've got a lot of numbers in front of me, so I'll try and sort of set them out relatively clearly. I mean, yeah, the headline number was 4.1. You can quibble about percentage points here and there. I mean, it was generally in line with what people had been anticipating. I suppose for me, it was up quite a bit from 3.1 in the previous quarter, and also above target. I mean, that's I guess what you keep coming back to is the Reserve Bank has this 1 to 3% target for headline CPI inflation over the medium term. It's 4.1. It's uncomfortably high, and I suppose that's what the bottom line is here. It was the highest rate since Q4 23. We had 4.7% back then. So you're talking whatever that is, sort of almost kind of 3 years ago in terms of the inflation rate. So yeah, I mean, in some ways, no surprises. We know that fuel's been an issue, and other things have been going up as well. So yeah, no huge surprises, but it's uncomfortably high compared to that target. Yeah, I'm always in two minds about core inflation and all these trimmed medians and stuff because if you take out everything that goes up, well, isn't that convenient? We've got no inflation, so I'm always a wee bit sort of cautious about that. But I also take the point that when you're thinking about sort of second round inflation and I guess the sort of underlying drivers, the things that I guess the Reserve Bank can really try and control, you do have to look at a sort of a measure that takes out some volatility, and so there's two sides of the story here. But yeah, I mean, if you take out fuel, in particular petrol here, because that's what is the big thing in terms of households. That's they're not necessarily, well, they're buying some diesel, but diesel's more, I guess, for the productive side of the economy. Consumer price index relates to households, and so they're spending a lot on petrol. So that's the big thing here. When you take that out, Stats New Zealand reckon that actually inflation would have been, I think it was it 2.9, somewhere around 3%. So yeah, if you strip out petrol, yes, and inflation might not look quite so scary, but fact is people are still having to spend a lot on petrol. So, like I say, sort of in two minds on that. But it does show the scale of change and how big an influence that's been, and particularly the past, well, sort of 4 months, I suppose it is, that these figures relate to. But other things went up too. I mean, electricity was up 12%. This is year on year. Council rates up 9%. Stats New Zealand reckon that combined, those two things accounted for about 1/7 of annual inflation. So again, if you take out petrol, if you take out electricity, if you take out council rates, you've got inflation of what, sort of 2.5%. Sort of comfortably within that target band. So it goes to show that there are some volatile things potentially that you take out, and you've got a steadier sort of underlying picture. But coming back to my point, well, isn't it convenient if you take everything that goes up, you've got no price pressure. So, sort of six one, half dozen the other on that. But I think probably, on the whole, the numbers, sounds a bit weird to say, the numbers were terrible, but it's still a bit uncomfortable for the Reserve Bank. One thing I suppose they'll take a little bit of comfort from is that the so-called non-tradable inflation, or that sort of domestic measure that's picking up things like rents, which are still pretty soft. That actually went down ever so slightly from 3.5% in Q1 to 3.4% in Q2. So a little bit of comfort there. So it shows that pretty much, well, all of the acceleration in inflation in Q2 came from tradable stuff. So things like your petrol or that sort of thing. And tradable inflation actually shot up from 2.5% in Q1 to 4.9 in Q2. So yeah, that's where the problem is. Again, no surprises. We know that's where the problem is. We know that petrol and fuel and imported stuff is problematic. So yeah, there's all those ways of cutting it, and some of the bank economists, some of their summary, what do you call it? Sort of they were feeling a little bit less panicked about inflation. Other people maybe had a sort of tone of, this is pretty problematic, isn't it? So it depends how you interpret the figures, like with a lot of things. But I think probably for me, the Reserve Bank, what are they thinking about? Well, they might take a little bit of comfort from, say, that non-tradable number, perhaps not accelerating away too badly. They might interpret that as going, well, we don't necessarily have to worry about second round inflation too much. Emerge right now doesn't mean it won't emerge, and they're trying to act in a forward-looking way and think about not what's happening necessarily right now, but what might be happening 6, 12, 18 months down the track, contingent on what they actually do with the OCR now. So, there's lots of circularity in here, but yeah, I think on the whole, and they've said in the past, and I think one of the bank economists picked up on this, is that actually, because a big thing in second round inflation is expectations. Will it's not so much what's happening now, but what households will expect to see in 6 to 12 months, and therefore what they might factor into their wage demands and that sort of stuff. And I think there's a sort of school of thought that says, households don't really take their cue from core inflation. What they see is the headline rate, 4.1%. They go, that's not great, is it? I'm going to ask for higher wages if they can, notwithstanding that our unemployment rate is above average right now. So, you can sort of argue about what's core and take out this and take out that. But if there's a school of thought that says actually what drives households' inflation expectations, it's simply the number they see in the news, that headline overall CPI number. And so probably that's what the Reserve Bank will be thinking about most. And factors, like I said at the start, that's above target. So yeah, how do I wrap it up? I mean, there's lots of numbers in there. I think it wasn't a horrendous number. I mean, that sounds weird to say that it's above target, but it's still a concern. I think in the end it changes too much. There was a pretty consensus expectation, I think, that we'll see that official cash rate go up again in September. I think it's 2nd of September. I don't think these numbers really change that. You could find good things in them, you could find bad things, but don't think enough either way to really shift that decision. So yeah, unless something changes in between now and then, which of course it could, but right now I think these numbers don't really sway it too much. So we're probably looking at that next rise in September as they try to get the OCR back to a so-called neutral level. So yeah, that's my take on it.
No, I agree with that. I think, like you said, is there anything in there to change them on the track they talk about, which is still trying to get the OCR back to its neutral level of 3.25%? And as you said, there's nothing in there really to change that expectation. I do think, there's a bit in there for everyone. If you want to look for reasons why you shouldn't lift the official cash rate on the 2nd of September, you can find reason in there, right? And it's usually looking at that core inflation data and saying, yeah, it's within the band. So, and also, like you said, if you strip out petrol and diesel prices, then it's not so bad. And again, so then it's about saying, well, if the expectation is that we do get, the de-escalation in Iran and the Strait of Hormuz opens again soon, and I know that, peace talks are on and off again, and maybe they're looking a bit more positive again this morning. Questions as to why that might be, but, I think there's definitely things in there that say we can justify saying, no, it's not that bad. We can see that once you strip these out, so once we get back to some level of normality with getting petrol flowing around the world, you're going to see that petrol price come back down again, and then you're just looking at the inflation of everything else. So it'll be fine. I mean, notwithstanding the fact that, like as you talked about, electricity prices and council, rates and things like that are still pretty expensive. But again, they can't really keep going up at the same rate they have for the last few years. I don't think they can. So again, you'd expect those to work their way through the system. So you could say there's justification here that shows that medium-term inflation, we should just see a spike in the short term, and that medium-term inflation gets back to somewhere closer to 3%, so you don't have to panic and fight against this inflation right now, because you can do more damage than you want. Equally, you could still look at that same data and you could go, but even if core inflation, when you strip out these things, if it's at 2.5 to 2.9%, depending on the core inflation measure you're using and what you're stripping out, that's still above the midpoint of 2%. And so that's in an environment where you're saying, I want to take these big things out. There's still actually inflation that's getting towards the higher end of the band. So you probably still want to make sure the official cash rate is less stimulatory, because you still want to see inflation come down. So that's equally a strong conversation or a strong argument to say it's still too high, even when you take out these massive volatile things. And to be honest, how long could they last? That spike could still be around for a while. So I do think it depends what you want to see or what you want to justify. But I think ultimately what always matters with all of this is the Reserve Bank's commentary. And that's why I think I go right back to that earlier point, which was, is there anything here to change them on their track, which has been a pretty consistent communication that says we are still in stimulatory phase. We still have an inflation problem. We want to get back to neutral. That expectation is that we get back to neutral by the end of this year, or very close to. If it's not the end of this year, then early next year. And September still feels like if there's any time you want to, much like they spoke about last time, want to get ahead of these things, you do it sooner rather than later. You're not going to wait for the one in late October. You're probably going to do it in September. Then you have a bit more data between then and late October before you can really assess what impact has that had. How much of some of these global impacts on inflation flowed through to real prices in New Zealand, you'll get a bit more data by October as well. So I feel like you'd have that comfort, and they still do seem to, if we go back to one of the old terms they used to use, the path of least regrets, it does feel like they're going to err on the side of caution, lift sooner rather than later, assess later on, and they can always hold for longer, or maybe there'll be a drop, sometime next year, who knows, depending on how inflation goes. If we do see the economy contract so much that it's putting more downward pressure on inflation, they can adjust that for that later on. So it does feel like that's their mentality. It is always a guessing game as to how they are reading things compared to what some of the bank economists might say or expect or want to see. But yeah, that's kind of what I always come back to. So yeah, I agree. Ultimately, we probably still see that lift, but it is still, what's that? Maybe 5 or 6 weeks away, that September decision. So there's still data to come out between now and then. The key one, of course, being 5th of August, which I think is next Wednesday, when we get labour market data for Q2 itself. So unemployment data, of course, we get all the deeper data behind that as well in terms of, what the participation rate is and some of the detail behind that. There were some stories about, obviously hard for young people to get jobs right now. I think the youth unemployment rate's like closer to 20%. So, there's some pretty strong or pretty big sections of our economy and labour market that are suffering right now. For now, the Reserve Bank seem to be mindful, but of course they're not targeted on that, and so they'll acknowledge it, but still say inflation is the worst of all evils. So we'll continue to fight against that, and the lift will do that. So yeah, as I say, still time between now and then, but I don't think there's anything here to shift them off their track of let's do one more in the short term, and get this closer to neutral before too long, and take that extra time between September and October to really assess the impact of all of this as well. So yeah, I think we're sort of probably sitting in a similar position, but you can absolutely find any detail you want in there to justify your position. Actually, the only other thing that I did write down that maybe we should touch on is that rents were up 0.1% over the quarter, so only very slightly up, and they've risen only 0.5% over the last year. So obviously not very much rental growth. You kind of touched on it earlier, we've talked about it before. Obviously that's flowing through to less growth in yield for property investors, and we've seen their activity reduce over the last 6 months as well. So this is all sort of playing together. That annual rise of 0.5% is the weakest we've seen in more than 2 decades as well. So it does just show how tough it is out there for property investors, for landlords out there, but of course great for tenants that their rents aren't going up. They're having to pay plenty in other things, but those rents aren't increasing at any sharp rate either. So yeah, that's the other factor, and maybe I think that's probably partly a measure of that second round inflation too. So again, could be a good sign that we're not going to see this flow through to greater increases in things like rents and wage increases. But it is still only one factor as well, so don't want to get too carried away by that one. But yeah, look, pretty decent coverage there of the CPI data. Anything else on your mind that might have sparked interest before we have a look at what else is in the news and what's coming up this week?
Yeah, just the mathematical technicality, I suppose. People talk about it all the time. People will have heard it before, but keep in mind inflation is a rate of change. So, if petrol is $3 now, if it's $3 in a year's time, it might still be expensive, but you'll have no inflation. The CPI will be zero. If everything else stayed unchanged as well. So, yeah, just keep in mind there's a big difference in terms of what the Reserve Bank's thinking about between the level of prices and the rate of change, and it's that rate of change that they really care about. I mean, petrol could go from $3 to $2.95 in a year's time. Might still be incredibly expensive, but you have deflation, so inflation will be negative. So yeah, there's just a technicality there to keep in mind.
No, that's a good point, and we don't actually see prices get much cheaper over time either. Once they go up, they do seem to be sort of systematically changed. That's not with everything, of course. There will be falls in prices of some things, but yeah, unfortunately, when you go through spikes in inflation, you don't necessarily see that stuff become reversed. It sort of sits at a high level. Now, petrol's probably a little more different. It definitely is a volatile product, of course, and so we will see that come back down to hopefully something back in the realms of, I don't know, $2 something, as opposed to the high twos and in that 3+. But yeah, outside of that, it's hard to see some of the other things coming back too much, and certainly things like council rates or insurance premiums, they're not going to suddenly return back to where they were a year or two ago, that's for sure. So some of these things get embedded, which, as you say, makes things in a broad sense, everything's very expensive, and even though the rate of change might slow down, still remains expensive, especially if you're not getting that increase in your wages to counterbalance that anyway. So yeah, another good technicality to point out. So thanks for that. The other thing around CPI actually, so we're not quite done yet, was that we did get sort of an official announcement from Stats NZ last week talking about moving to an official monthly CPI data release, testing to start in early 2027, so still some way away. And the expectation on their timeline was to have it essentially productionized, being used as the core tier one statistic for measuring CPI, which is what the Reserve Bank will, of course, be measured by themselves in August next year. So again, it's some time away. Don't want to get carried away with this, but of course, any time that we're moving to more frequent release of data, especially official tier one statistics like CPI data itself, is obviously a good thing as well. So look forward to that sometime away, worth noting, but yeah, not going to have too much influence in the short term anyway. So worth touching on that one. And then otherwise this week, man, I suppose the big one to set expectation for is, as I touched on earlier, July Home Value Index will be out to media on Friday, publicly released on Saturday, the 1st. So hopefully that doesn't mean too many media calls on your Saturday, Kelvin, or flying over to me on a Saturday. But yeah, I think it's good to have that out on the 1st of the month. So look forward to seeing the official data come out for that one later in the week. I mean, I suppose, as we usually do, have had a look at our weekly index, which is published on our website for Auckland, Wellington and Christchurch. And I mean, essentially, we're going to see that weakness continue through, right? We know that volumes aren't quite as strong, that typically means that values won't be growing either. And as I touched on earlier, Christchurch in particular, maybe even see values flat or slightly negative, which has been relatively unusual for the Christchurch market over the last wee while. But yeah, anything else you wanted to talk about from the potential data from Home Value Index released this week? I don't know if you've got any thoughts on the monthly CPI before we sort of wrap up property and economic chat.
No, I think you covered all of that. Yes, I mean, in a nutshell, I think it's going to be another flattish HVI result based on what we can see so far. So, yeah, again, be thinking of creative ways to create some interest in that, because it's yeah, could be pretty flat again.
You'll be banning yourself from using terms like more of the same, and
That's right.
yeah.
Yes, that's right. Tracking sideways.
Exactly. Or plateaus, or I suppose plateaus probably hasn't been used as much, so maybe you can throw that in there. But no, all good, mate. Well, we will leave the property and economic check there, mate. Probably doesn't feel like as much to catch up on from a personal perspective. Certainly from my end of things, pretty quiet weekend, typical stuff with family sport and whatnot. Less sport on TV to get hold of. Although I know Commonwealth games are in action, does feel pretty low key. Of course, they've stripped back many of the sports. The one that I've probably attached myself to was watching a bit of the 3x basketball, which, maybe part of it is the fact that the Tall Black, or the 3x Tall Blacks, if they're called that, seem pretty decent at that. So I was catching a bit of that last night and a bit of highlights of all the medal winning moments, but otherwise doesn't feel like it's getting as much coverage as it usually would. And as I said, maybe that's partly because there's been fewer sports involved in that. But otherwise, mate, I know you were away in Hanmer over the weekend. Must have been pretty chilly down there, mate.
It was, yes. It's not much fun going around the hot pools in bare feet on concrete that's, I don't know, 0 degrees or something. Like, my feet still feel cold this morning. So yeah, but I mean, it was cool. It's a sort of winter destination, and at least in my mind. A lot of people go in summer too, but in my mind, it's a winter place. And yeah, so you kind of want it to be cold in some ways. There was just a chance of snow, never really came to anything, but certainly some rain on Saturday, which meant it was fairly chilly, and then that cleared away. And Sunday, like, I mean, crazy frost. Our car was sitting outside, and it got up early-ish, and you couldn't actually open the doors, so they were just frozen shut. So yeah, pretty chilly, and the downside of bare feet at the hot pools is not cool. But we got a log fire inside, so we're okay. So can't complain too much, but it was cool. Family enjoys getting away, so yeah, loved it.
Nah, good on you, mate. Your feet feel like one of the things that just takes so long to heat back up again. So yeah, totally can understand that, mate. It hasn't been pretty wet and crappy here on Saturday, and had a storm roll in, which mostly missed us. But yeah, she was a pretty rough one on Saturday. But yeah, just a nice morning this morning, but again cold for Wellington. I think it got to 1 degree around the place, but has actually fined up to a nice day. So we'll take that, mate. But yeah, certainly feels like we're in the depths of winter now when you're getting those frosts and pretty chilly, and then the storm rolls in as well. It's not exactly ideal times.
For sure. Like I say, I've got the heater cranking here this morning, but the feet still feel a wee bit cold, hands are a wee bit cold. So yeah, but I can see the sun. So I don't know, first world problems.
Exactly. No, all good, mate. Well, we will leave it there for today, mate. But thanks very much, as per usual, for your insights. Always good to get into the detail of something like the CPI data where there's plenty to chat about, so I appreciate that. I just want to say thanks very much for listening. Please do feel free to get in touch with any questions or feedback, whether it's on the CPI data, on the chart pack, or you want to get a link to anything, please do let us know. But that'll do us for today. Just leaves me to say thanks again. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.